Hello everyone. Welcome to Compliance for All live webinar on accounting and tax procedures to maximize your deductions and minimize problems with the IRS. My name is Johnson and I'm going to be a host for today's session. On behalf of the Compliance for All team, I would like to thank you for being a part of today's event. Today's webinar will be presented by Mr. Ruben Rubinson. Mr. Rubinson is a CPA and has been licensed since 1979. He has received his MBA from New York University in 1977. He has been preparing tax returns for over 40 years and will be preparing the 2013 tax returns for approximately 150 individuals, 50 businesses, and 7 nonprofits. He currently acts as a Chief Financial Officer for 7 companies and consults with numerous others. He previously worked as a CFO or VP Finance for 3 publicly traded startup companies and has been responsible for accounting, IT, and human resources departments, developed policies and procedures, performed in-house legal reviews, and filed governmental reports and returns. We are honored to have such a distinguished person such as Mr. Rubinson with us to present today's webinar. Before we begin, I would like to inform you of the program outline for this training session. This webinar is for 90 minutes duration. First, Mr. Rubinson will take you through today's webinar highlighting the areas that would be covered, and he would then share with you his presentation. We'd like to inform all our participants once part of the teleconference have been placed on mute and will remain so until the Q&A begins towards the end of the webinar. We also request all to hold back your questions until the Q&A window begins. 10 minutes of time will be allotted for the Q&A, during which your questions will be answered. If for any reason you are logged out of this training session or teleconference, please follow the same procedure to join in again. Now that we are ready to start, I request Mr. Rubinson to take it from here. Mr. Rubinson.
Okay, great. Thank you very much, Johnson, and welcome everyone. And actually, one change to what Johnson said. I know you don't want to listen to me talking for over an hour straight, so I'm going to be pausing periodically to take questions after each section in that. And so if you'd like to ask questions as we go along each section, please feel free to send them in, and then at the end we'll have an open question and answer as well. So let's start. Here's my course outline, and let's see. So you can see we're going to go over the introductory information and personal, which we've done, look at internal control and policies, procedures for your accounting system, and going down to minimizing your tax liability. The purpose of this webinar is to share with you the system I have developed over the last 30-plus years to help small businesses to, 1, properly prepare their books and records, 2, ensure they're recording all of their expenses and other deductions, and 3, accumulate the documentation necessary to verify the information for the IRS and, maybe in the future, assist in an audit of your financial statements. Let me emphasize at the outset that I purposely use the word procedures in the title of my webinar. I'd like everyone on the call to ask themselves, do I have a set of policies and procedures for my business and my accounting department? For those of you that have answered yes, ask yourself, how often do I check to see that these policies and procedures are being followed? As we spend the next hour and a half together, I would like you to compare the information I am presenting to what you are currently doing in your business. As I mentioned earlier, I have been a licensed CPA since 1979. I would also note that in addition to being a CPA and CFO, I'm a computer programmer, and I have worked as the head of an IT department for 5 years. You might be asking yourself, what does computer programming and understanding technology have to do with being a CPA or CFO, or with creating policies and procedures? Well, first, most companies create and maintain their books and records using a software program nowadays, rather than by hand or using spreadsheets. Next, there's a perfectionism, a results-oriented questioning process with programming that is very helpful in developing policies and procedures. And lastly, there's a step-by-step logical thought process that goes into computer programming, which assists in analyzing a company's procedures. So everything we're talking about is logical, step-by-step, kind of like a flow chart. I like to start by defining what internal control is. According to the according to the Committee of Sponsoring Organizations of the Treadway Commission, commonly known as COSO, internal control is broadly defined as a process effected by an entity's board of directors, management, and other personnel, designed to provide reasonable assurance regarding the achievement of objectives in the following categories. 1, effectiveness and efficiency of operations. 2, reliability of financial reporting. And 3, compliance with applicable laws and regulations. In this webinar, we are going to touch on the effectiveness of your operations and concentrate on the reliability of your financial reports and compliance with IRS regulations. Okay, how do we... Next, let's look at the policies and procedures that run your accounting department. Here are some of the basic policies you need to follow. Access to accounting information restricted. Committing the company to expenditures controlled. Authority to authorize transactions limited. Job descriptions are maintained for all employees and include their duties and responsibilities. Segregation of duties. Procedures developed to support these policies are tested. And financial procedures are reviewed on a regular basis. So now let's look at some of the specific procedures you can implement in connection with this. Accounting software access. The first decision you need to make is which software program or packages you are going to use. For many smaller companies, an all-in-one software package, such as QuickBooks or Peachtree, is sufficient. However, if you are in a specialized industry, it may be better to use 2 separate software programs. You need to first look for the software program that will best handle your industry, your business line. If the specialized program has a good accounting program included, or which can be integrated with it, great. If not, you can always use 2 different systems. As an example, I had a client that was an auto repair shop. He needed a specialized program that allowed him to track parts and prepare estimates for customers. It also generated bills with all of the detail he needed and recorded the customer payments, tracking accounts receivable. In his situation, we generated a report from the specialized software program on a weekly basis and input a 6-line journal entry into the main accounting software program. Who has access? In his case, the specialized software program was accessible by all of his employees. However, the accounting software was located on a different computer where only the owner and the accounting department had access. In most cases, you'll have one software package that handles everything for you. In this case, you'll need to set up a system of passwords and access so that each user only has access to the information they need to know. You also want to store the file on a secure computer and back it up on a regular basis. And you need to make sure users do not share their login information with other employees and that passwords are changed on a regular basis. As an aside, when you terminate an employee, in addition to the normal policy of retrieving their keys and company equipment, you also need to look at any access they have to your information, both on-site and remotely, and make sure this access is terminated. In addition, you need to limit the ability to make changes to only those people who really need to make the changes. As an example, I have a client where I was called in and discovered the CEO of the company was changing the dates on money he had withdrawn, and as a result, underreporting to the board of directors the amount he owed the company. When we created a set of procedures for this company, we eliminated the ability of the CEO and senior management to make changes to the QuickBooks file. We gave them read-only privileges so they could access and view reports, but we took away their ability to make any changes to the file. If they want to make any changes now, they are forced to put it in writing and have the controller make the actual changes. This is an example of segregation of duties, which will be coming up over and over in this webinar. Next, let's look at who has the ability to commit the company for expenditures by signing contracts or making commitments. A lot of people say, I'm not worried about that. I sign all the checks. Well, unfortunately, when you see an invoice or have the check to sign, it's often too late to do anything about it. If one of your managers has made an agreement with a vendor to pay a certain amount of money, you may be legally obligated to honor that agreement. That's right. At that point, the only thing you may be able to legally do is sign the check. Accordingly, you should have in your employee handbook, hopefully you do have one, a statement as to who is allowed to sign contracts and agreements. Very often there is a statement that says the president is allowed to commit the company for expenditures up to, let's say, $10,000. The president and another executive officer are allowed to commit them up to, let's say, $50,000. And anything above this amount requires board approval. Obviously, you need to adjust the numbers and the positions based on the structure of your company. You also need to determine who sets the prices that your product is sold at or purchased for, and who is authorized to give customers and vendors discounts. Authority to authorize transactions. You need to have a written policy regarding the authorization of so-called accounting transactions. Who is authorized to make adjustments to customer and vendor balances and accounts receivable and accounts payable? Who is authorized to make journal entries in the books? And is there a maximum adjustment amount that can be initiated by one person? Finally, who determines when inventory is obsolete and should be thrown away or otherwise disposed of at a much lower than normal price? Also, talking about software, does your software have an audit trail, an audit log? And is it turned on? In the previous company where I discovered the CEO was changing the dates, I was able to go to the QuickBooks audit log and determine who made the changes, when they were made, so we were able to trace it right back to the CEO. Job descriptions. You should have job descriptions for all employees and update them on a regular basis. Let me repeat this. You should have job descriptions for all employees and update them on a regular basis. In an article dated January 1st, 2013, On the Society and Resources Management website, Michael Canisto states that, open quote, with the compliance environment and legal implications, the stakes are a lot higher for job descriptions to be crystal clear with essential responsibilities. If you have a measure of performance that doesn't appear on the job description and you have a legal case brought against you, depending on the agency involved, there could be punishment. Legal implications aside, you aren't operating your business as efficiently as possible if you don't keep job descriptions current. Job descriptions help with workforce planning. You can see how talent flows through the organization and holistically how it all fits together, end quote. I would add to this the benefits a job description provides to the employee. First, they're given a clear picture of what they are expected to do. To bring in my New York bluntness, how can an employee accept a position if they don't have a clear picture of what they are going to do? And after they're hired, having job descriptions gives them a roadmap to follow, showing them what is expected of them. And after you prepare an organizational chart as a follow-up to creating job descriptions, employees will know who and where to go if they have any questions in a particular area. Segregation of duties. Well, this section could be an entire webinar. Therefore, I'm going to just highlight some basic principles that need to be followed in several areas. Banking. Limit the number of authorized signers on the bank accounts. The person preparing the checks should not be able to sign them. If necessary, create a separate petty cash bank account with a small amount in it so the controller can issue checks for emergencies and money can be transferred into that account as necessary. As an example of how serious I am about this, in one of the publicly traded companies I was the CFO of, I was the accounting department. I did everything. Accordingly, I refused to be the signer on any bank account for that company. Bank statements. Ideally, the bank statement should go to the owner, CFO, or CPA so they can review the checks, and if feasible, one of them should do the bank reconciliation rather than the accounting department manager or controller who is handling the books on a regular basis. Accounting department. Expanding on the previous section, a procedure should be in place where checks are written and backup documents attached, and then they are given to the appropriate second person to sign the checks. The employee handling accounts receivable or accounts payable should not have the authority to make adjustments to the customer or vendor accounts. Payroll controls need to be in place regarding the submission and approval of timesheets, the processing of timesheets, and the reconciliation of payroll issued to the timesheets. The person recording the payroll should have nothing to do with the previous steps. Customers and sales. A procedure needs to be in place, how sales contracts are approved. This will include who has the authority to set the price and discounts, and what incentives are allowed to be offered. Ideally, your salesman, who is paid a commission based on gross sales, should have limited authority to grant discounts. They will grant discounts all day long because they are paid on the gross, not the net. A checklist needs to be in place, indicating what needs to happen before an order can be shipped out and who can authorize the release of an order. So you might have your sales department complete most of the items on the checklist and then turn it over to the fulfillment department, where the previous work is double-checked for completeness and the rest of the checklist relating to the actual shipping of the product is completed. It is then turned over to the warehouse, where the warehouse manager confirms all items on the checklist are completed. A procedure also needs to be in place where the sales documents are matched with the shipping documents, as the shipping documents are received from the shippers. This should be done by the accounting department, which is completely separate from the sales and fulfillment departments. Testing of procedures. It's one thing to have a set of procedures in place. Unless they are followed by your employees, you really have no controls. Therefore, it's crucial that these procedures be tested on a regular basis. If you have an internal or external auditor, they will normally perform this testing. Otherwise, you must set up another way for this to be done. If you have a good controller, he or she will probably make sure that the documents coming into the department are accurate and complete. This should ensure that the basic revenue and expenditures on the books are correct. If you have a good CFO or CPA looking over the work of the accounting department and the controller, they should be checking that the procedures will be followed on a regular basis. And every month or so, they should dig a little deeper and look into other areas to make sure that the various departments have been doing their jobs and the controller has been properly reviewing the documentation. Reviewing financial procedures. On an ongoing basis, the controller, CFO, or CPA should be looking to see if the procedures are accomplishing their goals and whether any modifications are needed. At least annually, an executive team should look over all the procedures for efficiency and duplication. They should examine how the pieces fit together and if there is any redundancy that can be eliminated or missing pieces that need to be added. So I'll stop a second to see if you have any questions on what I've covered before I move on to the next section. Can everyone hear me? Is there any questions? Are we good, Johnson?
We are good, Mr. Rubinson. No questions come up now.
Okay, great. So now let's move on to the next section, your accounting bookkeeping system. Now I'm going to focus on your accounting bookkeeping system, your books and records. Over the last 35 plus years, I've worked with over 100 small businesses and helped them set up their accounting software, chart of accounts, and accounting procedures. In this section, I will share with you many of the tips and suggestions I make to these businesses. Invariably, one of the first questions I get from a business owner or controller is, what is the right chart of accounts? Using my sarcastic New York humor, I usually respond, beats the heck out of me. What information do you need to run your business? Let's explore this a little bit. What do you think the purpose of an accounting system is? According to the American Accounting Association, accounting is the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by the users of the information. In this section of the webinar, I am going to talk about identifying and measuring economic information. In this section, I want to focus on the communication of the information for decision-making processes. The purpose of your accounting system in general and the chart of accounts specifically are to present information to management so they can make intelligent decisions. That's right, my job is to present the information and let the business owner make the decision. Accordingly, I need to know what information the owner or management of the company is going to be using in the decision-making process. For most companies, there are several numbers they use to run the company. As an aside, I had a restaurant as a client several years ago, and one of the most critical information they used to run their business was they went to the credit card slips, and they looked at what percentage of tips every server was receiving. If most of the servers were getting 15% or so, and another server was only getting 10%, they knew something was wrong. They knew customers were not happy. And it was critical to them because they know customers often just walk out if they're not happy. They don't tell anyone. So this was a real smart way. They were able to track how their servers were doing. It's obviously not something for this webinar and not something most businesses can use, but you need to get creative. Each owner needs to get creative and see what information is really important to them that can help them steer their business and realize when changes need to be made. When you create a chart of accounts, there is a trade-off in determining how much detail to go into. Some people would argue the more detail, the better. The problem with this is the time involved in separating the data in order to get the detail, and the fact that by having too much detail, people get lost and they don't even use the information. For example, I have a client who sells and installs plumbing products. He's been in the business for over 15 years. He breaks his advertising expense and his cost of goods sold into over 10 categories each. When I saw this, my initial reaction was this was a complete waste of time for the bookkeeper. For most companies, advertising is thrown into one or two categories. Here they were using radio, mailings, and numerous other subcategories. However, as I work with the owner, I realized each of these ways of advertising was different to them, and they really needed the amounts shown separately. And I've sat down with them many times, and when they calculate the cost of goods sold percentages, they know what they should be. And sometimes they tell me, for example, installation expense is wrong. And when we look into the detail, sure enough, it turns out that the bookkeeper has usually posted a new vendor to the wrong expense category. To use another example in a different area, I have been on the boards of several nonprofits, and one of the first things the board members do when they receive financial statements is separate the program expenses from the operating expenses. Why do this? Completely unnecessary when you can set up operating expense section to break out the numbers separately, or even better, put the program expenses into the cost of goods sold section, since they really are cost of goods sold for a nonprofit. In other words, customize the chart of accounts so you present information that the owners really need to know. In addition to setting up the chart of accounts to provide crucial numbers to the owners, you also need to set up certain accounts to track information, both for your tax returns and for other analysis purposes. For example, I see many companies have a payroll account and they put the net check into that account. Then they put the deductions and the taxes that were paid out into the payroll taxes account. So if we look over here, they take the $650 net check that was actually paid and put it into salary expense. And they take the $350 and they put it as payroll taxes. So in the first way on their books, they have $650 of salaries and then $450, which is the $350 plus the actual taxes paid. There are three major problems with recording the transaction this way. First, the IRS matches the amount of wages reported on the tax return to the amounts reported to the Social Security Administration on the annual W-3. If there is a difference, you may get a notice from the IRS. Second, you're unable to properly analyze the expenses. I always compare salary expense to the amount reported on the 941 for discrepancies. I also calculate payroll taxes as a percentage of salaries, which should be between 8 and 10%. By making this analytical review, I often pick up mistakes. Now let's look at the way I recommend it. I take the $1,000 gross salary and I put it into salary expense. I take the payroll tax expense, this $100, and book it over here. Now I have an amount, $1,000, that will match with the 941 and with the W-3. And I have a payroll tax expense, which is 10% of the salaries, which is within reason. And you can miss other issues if you don't do it this way. I always like to create zero balance transfer accounts for payroll and other situations where applicable. One example of this is wage garnishment. When the money is taken out of the employee's paycheck, it goes into this account. And when the money is paid to the appropriate agency, it comes out of the account, creating a zero balance. If there is anything other than a zero balance, it usually means that you forgot to make a payment or you put something into the wrong account. As an example of why zero balance accounts are important, I recently had a client where I was analyzing his payroll as part of preparing his 2013 tax return. As part of the process, he did it the old way, so I recorded everything based on the way I like to do it. After doing this, I discovered that the previous October, the company had issued payroll to an employee, voided the payroll, and then reissued a new check in a different amount. Sounds good, but the problem was that they were using direct deposit for this employee. And when they tried to get the money back from the employee for the voided check, the bank rejected the pullback. Therefore, the employee had both of the payroll checks deposited in his account with no withdrawal, and he actually owed the company $3,500. The only way I found it was that there was a zero balance transfer account that should have had a zero balance, and it ended up with a $3,500 balance. Okay, come on. Now let's look at two other situations that companies commonly have. Many companies offer some kind of employee benefit coverage, like medical insurance, and collect, let's say, 25% of the premium from their employees. If you set up one account for medical insurance and a second account for reimbursements received, you can easily calculate if you are receiving 25% of the payments. If the reimbursement account is lower than 25%, it could mean you either forgot to collect money from the employee or the insurance company raised your premiums and you never increased the amount you are collecting from the employee. A second situation is where you incur expenses on behalf of a client and bill them for reimbursement. Once again, if the expense account is higher than the reimbursement account, you need to investigate why. Obviously, there are timing differences, but using these accounts gives you an alert, a heads up, a red flag, so you don't miss anything. While I'm on the subject of reimbursement, it's very important that you keep a separate meals and entertainment reimbursement account, or otherwise track this expense if you are billing your travel and entertainment expenses to your clients. As we'll discuss later, meals and entertainment are only deductible at 50%. However, if you bill them through to your customers and then collect the reimbursement, you can deduct the entire amount of the meal or entertainment because you've passed on the 50% haircut to your customer. Another consideration in setting up chart of accounts is the legal structure of your business and where certain items are going to appear on the tax return. For example, S-Corps and LLCs are pass-through entities, and there are certain items of income or expense that are not included as part of ordinary income. Accordingly, you may want to use the other income and other expense section of most software chart of accounts for expenses like charitable contributions, interest income, Section 179 depreciation, and capital gains and losses. Likewise, if you have rental operations, they are shown on a completely separate IRS form. Therefore, you may want to also separate your rental operations in the chart of accounts. Finally, you need to think ahead and considering that you're going to be issuing 1099s. A lot of companies, based on the IRS tax return categories, have one account for legal and professional fees. Unfortunately, legal fees go into one box on the 1099s, and other professional fees go into a different box. What I recommend is to set up a main account called legal and professional fees, and then sub-accounts for legal, accounting, and other professional fees. Likewise, rent should be in a separate category, as well as royalties. While I'm talking about 1099s, let me add you should have a W-9 from everyone that provides services. First reason is it's needed to meet your 1099 reporting requirements. Also, if you don't issue a 1099 to a company because they're a corporation, if you are ever questioned by the IRS, you have a written record that they told you they're a corporation. And I find often you might think someone is a corporation, but when you get the W-9, it shows they're an LLC, and LLCs need to be issued 1099s. Another situation I run into is people tell me they don't need to be issued a 1099 because they are a corporation, or they tell me to issue the 1099s in their company name rather than their personal name, even though the original checks are written to them. My position is the 1099 must be issued to the entity that checks were written to. Therefore, unless someone is willing to return the money and have the checks reissued in the corporation name, I say issue the 1099s to them personally. And please note that if you pay someone for services and you don't have their Social Security or federal ID number, you're supposed to withhold 28% of the payment and submit it to the IRS as backup withholding. Have fun telling that to your vendor when you give them the check and you've reduced it by almost 30%. Also, you need to know that if you don't issue a 1099 and you're audited, the IRS may limit your deduction to $600. And I know in the state of California, they could disallow the entire expense, and you get zero as the deduction. Any questions from anyone on the chart of accounts or anything I've covered so far?
Well, Mr. Rubinson, I don't see any questions coming up.
Okay, great. So now let's move on, I think, to the section most people have been waiting for. How do I minimize my tax liability? How do I pay as little taxes as possible? The simple answer is you deduct every allowable expense on your tax return and take advantage of special IRS and state incentives. So what expenses are you allowed to deduct? The answer is anything that is an open quote, ordinary and necessary business expense, close quote, as long as it is not extravagant. As you can read, an ordinary expense is one that is common and accepted in your trade or business. A necessary expense is one that is helpful and appropriate for your trade or business. An expense does not have to be indispensable to be considered necessary. And generally, you cannot deduct personal, living, or family expenses. Frankly, everyone needs to define ordinary and necessary for themselves. What I tell my clients is to make believe, God forbid, they are going through an IRS audit, and the auditor has asked you why an item is ordinary and why it is necessary for your business. If you can honestly answer both questions with a good reason, then I would say take the deduction. On the other hand, there are some people who don't like to take chances and are afraid of upsetting the IRS. For them, they will take a more conservative approach. All I can do is give you the information, and you have to make the decision how aggressive or how conservative you want to be. As an example, I have a newspaper subscription to my local paper. It is important to me and my business to keep up on current events and read what is going on in the business community. I feel it is both ordinary and necessary, and I take the deduction. If I was preparing the same return for my mother, I probably wouldn't deduct it. Now, having said the above, you need to be aware that certain expenses are specifically prohibited. Fines and penalties, political contribution, business gifts over $25, illegal activities, country club dues, commuting expenses. In addition, clothing generally is not deducted if it can be used for personal use, unless there is a logo or other advertisement for the business. So the bad news is all the suits I buy for going to meetings and seeing clients, I cannot deduct them. I cannot deduct their costs because I could use them for other purposes. I'd have to have embroidered on the suits my business logo if I wanted to deduct them. The good news is that when I have them dry cleaned for business purposes, I can take the dry cleaning. And as much as I don't like a lot of what the IRS puts out, IRS Publication 523 will give you a lot of information and a lot of details on what you can and cannot deduct. So the following items are pretty straightforward as far as deducting them. Business rent and utilities, advertising, marketing, business insurance, office expenses, business travel, legal accounting, and other professional fees relating to your business. All those straightforward, you can deduct them because they are ordinary and necessary. I'm now going to discuss other expense categories where there are some issues you need to be aware of. And I'm going to emphasize here that anything you learn or see in this webinar needs to be discussed with a qualified tax professional. Often there are exceptions to the general rule, or the rule only applies under certain circumstances. Accordingly, someone needs to make sure that you meet all the requirements for taking any deductions. So please consult with your tax professional, your CPA, your enrolled agent, whoever you are using to prepare your tax return and prepare your books. As stated by the IRS, if your business manufactures products or purchases them for resale, you generally must value inventory at the beginning and the end of each year to determine your cost of goods sold. In other words, you cannot deduct what you pay for this merchandise in the initial year when you bought it. If you have stuff at the end of the year, you must record it as an asset. In addition, some of your expenses may need to be included in figuring the cost of goods sold. So once again, you should consult with your tax advisor to determine exactly which expenditures need to be included as part of your inventory cost. It's possible that direct labor, the cost of factory overhead, and other items need to be included as part of cost of goods sold rather than being immediately expensed, even if you're on the cash basis of accounting. Advertising. As I said before, advertising is pretty straightforward, but I'll make a comment here. Many companies take out advertisements or sponsorships for nonprofit organizations and deduct the expense as a charitable contribution because the check's made out to a charity. Well, guess what? In almost all cases, a deduction for advertising is more beneficial than one for a charitable contribution. Accordingly, if you are legitimately advertising or promoting your business, you are probably better off classifying that expenditure as an advertisement versus a charitable contribution. Automobile expenses. Automobile and truck expenses are a category where you have some leeway. The IRS allows you to deduct the greater of your actual business expenses or an amount calculated by multiplying the miles driven times a standard mileage rate, which was 56.5 cents last year and 56 cents in 2014. Your actual business expenses include not only your gas, repair, and other expenditures, but also depreciation of your vehicle. And after you accumulate your total expenses, your total actual expenses, you then need to multiply this amount by the percentage the vehicle was used for business. So in other words, you still have to keep track of your mileage and determine the amount of business use for your vehicle, even if you're using actual mileage. And I'll say here that if you elect to use actual expenses in the first year you had the vehicle, and you took accelerated depreciation, in subsequent years you are not allowed to use the mileage method. And whether you use the actual or the mileage method, it's important that you are allowed to deduct 100% of the business parking and toll expense. In other words, therefore, it's important to keep track of these items separately, usually in a separate account in the general ledger, using the system I described earlier. Now let's look at some of the record-keeping requirements for automobile expense. The IRS requires that you keep a contemporaneous log of the miles you drove. They want you to keep record on a daily basis, not monthly, not when you get audited by the IRS. The good news is you don't have to keep track of everything for the entire year. So my first tip here is that the IRS will allow you to keep track of your miles for 90 days and use the percentages from this time period to calculate the miles driven during the entire year, as long as that time period is representative for the full year. So you can keep your miles from September 1st to December 1st and use these percentages to calculate the allocation of the miles, which I'll explain in a minute, for the entire year. My next tip is you don't have to keep track of every single trip that you take. If most of your driving is for business, what you can do is the following. Here's a log. You can record your beginning mileage as of September 1st. That's your odometer reading. Now you're going to create a log like you see on the screen with columns for beginning mileage, ending mileage, trip description, date, and category. And the category is going to be personal, charity, or medical. During the next 3 months, you're going to fill in the first column, the trip description column, with a brief description of the purpose of the trip. So on September 1st, I went to Mary Smith client and John Doe client, and I went to the grocery store. Notice that the only mileage I'm filling in is for the grocery store over here. For any trip that is not business, as I said, you write down the beginning and ending odometer reading. As most of your trips are for business, at least in my case, this may only be 25% or less of the number of trips. At the end of the period, you're going to write down your odometer reading, and you have now finished your contemporaneous log. Then you create an Excel spreadsheet which will subtract the ending mileage from the beginning mileage for each non-business trip. So here is your beginning mileage, ending mileage. So this was 10 miles for personal. I went to the grocery store. Here I put down a charity fundraiser, 49. Here I went to the doctor, 25. So during the 3-month period from September 1st to December 1st, I drove 25,000 at the beginning, 31,000, so my total miles was 6. When I add these 3 up, they add up to 84, which is my non-business. Therefore, my business mileage is 5,916. So, what will happen now is if I drove 20 or 30,000 miles during the entire year, 5,916 over 6,000 creates a percentage. I multiply that times the 20 or 30,000 I drove during the entire year, and that gives me the amount of business miles for the year. Medical, which I can take as a lower rate, and charity I can take as a lower rate, are again going to be the percentages where 25 or 49 is the numerator and 6,000 is the denominator. Are there any questions at this point regarding automobile or the other couple of expenses I've talked about?
Well, Mr. Rubinson, there are no questions in my chat panel or the Q&A panel.
Okay. Now let's look at bad debts. The first thing to understand here is that there is no deduction for uncollectible accounts if you are on the cash basis of accounting, which many small companies are. The reason is you never pick them up as income in the first place. Therefore, you don't get a deduction when they go bad. For accrual basis taxpayers, I'll also mention, generally accepted accounting principles, otherwise known as GAAP, allow you to calculate bad debt expense using a percentage estimate. However, for IRS purposes, you have to specifically identify which customers you're writing off. So you can't say, normally 5 or 10% of my receivables go bad, therefore I'm going to write off 5 or 10% on my tax return. It's not allowed. Cell phones. Cell phones used to be included under listed property, and there were questions regarding their deductibility. In 2011, the IRS changed this, and they now stated that, open quote, where employees provide cell phones to their employees, or where employers reimburse employees for business use of their personal cell phones, tax-free treatment is available without the burdensome reporting record-keeping requirements. The guidance does not apply to cell phones or reimbursement for cell phone use that is not primarily business related. As such, arrangements are generally taxable, end quote. In other words, as long as the cell phone is used primarily for business, the business can take a deduction for the expenditure, and any amounts paid to the employee as a reimbursement are not taxable to them. Charitable contributions. Well, I'm sorry to tell you, but you get no charitable deduction for volunteer services provided to a nonprofit organization. I spend a lot of time volunteering for nonprofits, for the board, for ushering at nonprofits. I do not get a tax deduction for any of my time. I wish I did. I'd lower my taxes substantially. The only thing you can deduct is out-of-pocket costs. So if I drive to a nonprofit, I have to record my mileage and I get a tax deduction. If I buy something for the nonprofit, I can get a deduction as a charitable contribution. Next, a charitable organization must provide a written disclosure statement to donors of any quid pro quo contribution in excess of $75 and provide the donor with a good faith estimate of the goods or services that the donor received. So if you have a fundraising event and you pay $100 for a ticket which includes a meal, the organization must tell you, for example, that $40 was the value of the meal and you get $60 as a charitable contribution. This is what you mean by quid pro quo. In addition, a donor claiming a deduction of $250 or more is required to obtain and keep a contemporaneous written acknowledgement for a charitable contribution. To be contemporaneous, the written acknowledgement must generally be obtained by the donor no later than the date the donor files a tax return for the year the contribution is made. Here's something very important. The written acknowledgement must state whether the donor provides any goods or services in consideration. So some receipts I say this contribution is deductible to the full extent of the law, or this is fully tax deductible. The problem is it must state there were no goods or services received in connection with this charitable contribution. If it doesn't say that, then you have a problem. In a recent court case, a couple made a charitable contribution to a church. The IRS audited them. The church donation receipt did not say no goods or services were received for this contribution. Both the IRS and the taxpayer agreed. The contribution was made, the check was issued, everyone agreed on all the facts. The decision in the court hinged on how strict is the requirement that the receipt state no goods or services were received. In this case, the court looked at what the law said, and they said, yes, it must have it. And in this case, the couple lost a charitable contribution of $22,517 because the church did not have this wording on their receipt. I would not like to be on the board of that church when this hit the fan. Next, charitable contributions over $5,000. Generally, a qualified appraisal, if it's something that you donated, must be prepared by a qualified appraiser and submitted with your tax return. And I'll just add a last item, that household goods, clothing, goods, items donated to charity after 2006 must be in at least good condition to be deductible. It is common knowledge that expenditures for computers, equipment, furniture, and fixtures and other long-lived assets have special treatment. The basic rule is that the cost of these assets have to be spread out using an IRS convention such as Makers or Straight Line, which uses sort of the property's estimated useful life. However, this is only a starting point. Under rules issued in 2013, the IRS has created a safe harbor so you can elect to immediately expense any item costing $500 or less as a regular expense, deducted as office expense, because it's not material. This gets rid of all of your small items. And please make sure you make this election to use this safe harbor on your 2013 or 2014 tax return. The next exception has to do with Section 179 depreciation. For most small businesses, this section of the IRS code will allow you to deduct on your 2013 and 2012 tax returns up to $500,000 of the cost of eligible long-lived assets in the year you purchased them. Please note the deduction is limited to your income, and any excess can be carried forward an unlimited number of years. And also please note that if you're an S Corp or partnership, the income is first calculated at the company level, where it is then passed through to the shareholder. Then the shareholder calculates it again using the income limitation at the shareholder level. Congress has also enacted other types of depreciation deductions, such as bonus depreciation. And there are other tax strategies that you may want to use in order to maximize your deductions based on your circumstances. As I said earlier, you should consult with your tax preparer to determine the best treatment for you. In addition to these fixed assets which are depreciated, there are also assets that may need to be amortized, such as goodwill, organizational costs. Organizational costs can sometimes be expensed directly. There are very specific rules here, and you need to consult with your tax advisor if you have any of these items. And if you are involved in mining or mineral exploration or any other line of business that requires depletion, this expense is beyond the scope of this webinar, and you need to consult with a qualified expert in determining the best method to use. Now let's look at employee benefit programs. The first thing you need to determine is if you have a qualified or non-qualified plan. You should consult with your tax advisor prior to setting up the plan, as its qualifications will affect both the company and other deductions. Let me bring in here the issue of health insurance premiums for owners. If you are more than a 2% owner of an S corporation, you are not allowed to deduct directly on the health insurance premiums on your partnership or S Corp tax return. Rather, you need to do two things. First, the items are passed through to you personally on a separate line on the K-1, so that you can deduct them as self-employed health insurance premiums on your personal 1040, as if you were a sole proprietor. Secondly, you must add the amounts to your W-2 and deduct them as taxable wages. If your medical plan is a qualified plan, these additional wages are only subject to federal withholding. However, if it's a non-qualified plan, FICA and Medicare taxes have to be paid on the amount. Now let's move on to home office deductibility. This is a topic that could take up the entire webinar. I just want to talk here about the basics and some misconceptions that are floating around. The basic rule is you can deduct expenses for a home office if it is used exclusively and on a regular basis for business purposes. It does not have to be your primary place of business. So if you have one room in your apartment or house that is used exclusively for business, and it is 10% of the square footage of the entire apartment or house, you can deduct 10% of your rent, utilities, and similar expenses. You can also deduct any expenses that were specifically related to that room, such as building shelving in it for your business. Now let's look at some other issues. If you're using your room for business that has a bed in it as a spare bedroom, you cannot deduct it as a home office because it does not meet the exclusivity requirement. Similarly, I have seen publications say if you entertain clients in your house on a regular basis, you can deduct your entire living room and kitchen as part of your home office. I've seen this in a couple of multi-level marketing publications. This type of statement is obviously untrue because it does not meet the exclusivity requirement. Another point to consider is the IRS takes the position you have to have a home phone. Accordingly, if you have only one phone in your house and you use it for sending and receiving faxes, you cannot deduct the base monthly cost of it, only the long distance and other charges related to sending faxes. Let me briefly touch on the issue of independent contractors or consultants. Both the IRS and most states are scrutinizing the use of independent contractors to see if they are really employees. The cost of improperly classifying employees as independent contractors can be substantial. Not only will you have to pay back payroll taxes, but you will also be charged interest and penalties. And in the state of California, if they determine that you have a pattern of misclassifying employees as independent contractors, are you ready? You can be assessed with a fine of $25,000 per misclassified employee. That's right, per employee. I'll let you do the math at how this can add up. How do you avoid this? The first rule I tell my clients is to get a copy of their business license. If they cannot provide you with a business license, I say they are employees. For me, this rule is set in stone. Also determine if they have a specific skill, whether they make independent decisions, and if your company controls their work. In other words, your company can really only tell them what you want done, the result of the project, and then they have to use their expertise to complete the project. Also, while you may give them a guideline, you should not tell them the specific hours they must work. My guess is these simple rules above will eliminate 90% of your potential independent contractors who really should be employees. If you have more questions, look at the 24-point test the IRS uses. Look at the different tests that your state uses. and consult with your tax advisor before making any final decisions. If they can produce a business license and they meet the other requirements listed above, you should have a consulting agreement with them, outlining the conditions of their engagement and specifically indicating they're an independent contractor. In addition, obtain a copy of their business card and any advertisements they may be making to the general public. And have them fill out a W-9 before you issue them a check, as I indicated previously. Additionally, if they are operating as an individual, you need to get their Social Security number in California and send it into the EDD so the EDD can check to see if they are behind on child support. Unfortunately, this can create a problem because if they refuse to provide you their Social Security number and only provide a federal ID number, you cannot legally require them to give you their Social Security number. For other states, there may be other requirements, so check with your qualified advisor, check with your tax professional to make sure if there are any similar requirements for the state. With regard to insurance, I have two basic comments. First, life insurance premiums for the owner of the business are generally not deductible. Also, as described above, health insurance premiums on the 2% owners are generally not deductible insurance, but need to be passed on. Meals and entertainment are a category where people often get into trouble. According to the IRS, you can deduct ordinary and necessary expenses to entertain a client, customer, or employee if the expenses meet the directly related or the associated test. To meet the directly related, you must show that the main purpose of the combined business and entertainment was the active conduct of business. I'll repeat, the main purpose. You also must engage in business with the person during the entertainment period. And 3, you had more than a general expectation of getting income or some other specific business benefit at some future date, which I'll describe in a minute. In addition, there are very specific IRS documentation requirements. You must have a contemporaneous record of who you entertained and what the business purpose of the meeting was, in addition to where and when you entertained them. Here's another tip. My recommendation is to fill out your copy of the credit card slip with the name of the person and the business purpose. Then take a picture of the receipt with your cell phone before you leave the table. Personally, I have a folder on my cell phone where I keep the pictures and copy them to a folder on my desktop. For a small company, you may want the employee to send a copy of the picture to the accounting department so they can match them up with the company credit card statements when they come in. And you can also use this picture-taking technique for other uses by employees and the owners of the company credit card. A few comments on meals and entertainment expenses. As I stated previously, if you are going to be reimbursed by your client for the expense, you need to properly record it so you can get the entire deduction rather than 50%. Also, there's an old saying that pigs get slaughtered that comes into play here. You cannot make an arrangement with another business person and have lunch together every week and trade off who is going to pay the bill and then expect to deduct it every time it's your turn to pay. Unless there is a legitimate business reason to have such frequent meetings, the IRS will disallow the expense. As mentioned earlier, events that are associated with a business meeting are also deductible. This means if you have a legitimate business dinner with a client and then take them to the theater or a sports event afterwards, You can deduct the cost of the theater tickets or sports event, even though no business takes place at the theater or sports event. So the requirement of active conduct of a business is not necessary if an event is associated with a business meeting. Again, I'll pause for a minute before I go to my last quick section to see if there are any questions.
Well, Mr. Rubinson, there's no questions coming.
Okay, great. Let's go to the last part, which is working with your tax preparer. The final item I'd like to discuss is working with your tax preparer, or maybe better said, what to look for in a good tax preparer. I think the best way to start this off is to discuss a new client who recently engaged me to prepare his 2013 business tax return. He told me he had been in business for several years and that his books and records were in order, and this was going to be an easy tax return. I know, I can hear some of you laughing and saying famous last words. After talking to him on the phone, I sent him an engagement letter, and he called me back the next day. He told me he was sending the signed letter, but was curious about my questions as to what states he had done business in. I told him I had looked on his website, and I saw he had a product which was sold not only in California, but also in the states of Minnesota and Washington. I told him he was probably required to register in both states as a foreign corporation doing business there, and potentially required to file state and personal tax returns in both states, as well as his home state of California. He told me he was registered in both foreign states, but he had never filed tax returns for either one of them. When we investigated further, we determined there was no filing requirement in Washington, but he should have been filing in Minnesota for the last 7 years. I am now working with the state of Minnesota to correct the situation. He then sent me a copy of his profit and loss from QuickBooks. I told him I'd like to get a copy of the file so I can drill down on some of the accounts. When I did this, I discovered he was treating the premiums he paid for health insurance for himself and his wife incorrectly. He didn't follow the procedures I outlined earlier for more than 2% shareholders. Also, I picked up on some other issues, that things were being recorded improperly. When I was done, he told me I was the first CPA he had dealt with who had gone into so much detail. And he asked me, why did the other CPAs ask me? My response was, when I sign a return as a tax preparer, I am certifying under penalty of perjury that, open quote, to the best of my knowledge and belief, it is true, accurate, and complete. If I'm going to sign that statement under penalty of perjury, I have to do a certain amount of verification in order to make sure the certification, I'm signing and certifying this with integrity. By the way, when you sign a tax return, you are making the same certification under penalty of perjury. I don't care if you relied on your tax preparer. You are ultimately responsible for what goes on that tax return. So here are a few things you should look for in order to ensure you have a good tax preparer. When you hired the tax preparer, did he or she ask you for a copy of the previous year's tax return? Did he or she re-enter the information? I make it a practice to re-enter the information so I can better understand the business. Additionally, there are carryovers from year to year that are often missed if you don't redo the prior year's tax return. Does your tax preparer ask you questions about the profit and loss statement you provided to them? Asking questions is the only way for a tax preparer to understand your business. You are paying good money for their expertise. To put it bluntly, a robot could be trained to look at a profit and loss statement and transfer numbers to a tax return. You want someone thinking while they are going through the profit and loss statement and not blindly transferring numbers off it. Does your tax preparer advise you of new IRS rules and credits? For example, if your business is growing, there is a new jobs credit that you may be able to take advantage of. Also, you are now allowed to deduct most research and development expenses in the year they are incurred, rather than spreading them out over several years. Finally, there is a manufacturing credit available in certain industries. So again, does your tax preparer discuss this with you? Does your tax preparer go over the tax return and explain to you alternative treatments and let you make a decision which one to follow? This is one of my pet peeves. It kills me when I ask a client why something was done on a tax return and their response is, I don't know. I gave it to my tax preparer and they just gave me the tax return to sign. As I said to be above, I hate to be the bearer of bad news, but you are responsible for everything that goes on your tax return. You cannot shift this responsibility to your tax preparer. Therefore, don't be afraid of asking questions. And to be fair to your tax preparer, if you wait until the last minute to send them your tax information, don't be surprised if they tell you you have to go on extension, and they will explain it to you in detail after April 15th. Is your tax preparer in communication with you during the year? Is he or she available to answer questions as they come up? For small businesses, I believe it is a good practice for your CPA or tax preparer to look over your books on a quarterly or semi-annual basis. At a minimum, your tax preparer should talk with you at the end of October or November so they can assist you in any tax planning that is necessary before the end of the year. In addition, they should be available for a reasonable number of phone calls during the year at no additional charge. What I offer my clients, as a final note, is an annual package that includes not only the preparation of the tax return, but also looking over their books and all phone calls. And if the company is growing and needs additional guidance, I am available as a CFO for hire on a schedule for work that works for both myself and the client, usually monthly or quarterly. That's all I have for you now. Thank you very much for this opportunity to share my expertise with you. I'm sure you learned a lot and got a lot of value out of it. I hope you will be able to use many of the ideas and tips I have discussed with you in your business. I'll now move on to answering any questions you might have. So, Johnson, please take it from here and let me know what questions the participants have.
Thank you so much, Mr. Rubinson, for the wonderful presentation, and also would like to thank all participants for listening to us today. It's now time for the Q&A to begin. In case you have any questions, you can go ahead and post them on the Q&A panel or my chat box, and I can have them passed over to our presenter to read it out loud and have them answered. In the meanwhile, we request you to share your feedback with us. The feedback form will appear on your polling panel right now, and it would have about 8 questions, mostly multiple choice in nature, and wouldn't take more than 2 minutes of your time to complete the same. The feedback form will be open till the end of the session. Just to remind all our participants that the Q&A session is in progress. In case you have any questions, please feel free to go ahead and post them on my chat box or the Q&A panel, and we could have them answered for you. While we're waiting for some questions to come in, we would like to inform all our participants that in case your colleagues, friends might benefit from this webinar, this would be available in a recorded format, and please do give us a call at our toll-free number or visit our website at complianceforall.com to have this purchased. Well, Mr. Rubinson, I don't see any questions coming in. Is there any concluding remarks before you want to close today's session?
No, I guess everyone has my name. If anyone wants to send me an email, Well, go to my website, I'm available, and, I hope everyone's gotten a lot of value out of it, between my accounting practice and my teaching graduate and undergraduate accounting. I've run into lots of situations, and, I hope that many of the items and tips I've outlined will be helpful to you in your business.
Thank you so much, Mr. Robinson. Well, ladies and gentlemen, we welcome your suggestions and feedbacks or ideas on how we can improve our webinars. If you would like to suggest a topic or desire a customized corporate training, both online or on-site, we ensure whatever your training necessity is, it would be our priority. We look forward to having you with us again sometime soon, and for your continued patronage. On behalf of our presenter, Mr. Ruben Robinson, and the Compliance for All team, I would like to thank you for participating in today's webinar, and we wish you a pleasant day ahead.